All right. All right, we here. Josh, can you hear me all right?
I can hear you. Are you hearing me?
I am. Give me one. All right, there we go. Had a little bit of an echo. All is good now. Hey guys, welcome back. Happy Wednesday. Josh and I here, back with your live Wednesday night, answering your real estate questions here to help guide you guys through the real estate process, hopefully make things a little bit easier to understand. But part of that is you guys leaving questions there below. Otherwise, Josh and I just talk about random things that you guys don't care about. So, put those questions in the comments. We'll definitely get started with them. But normally, we have a routine here, and we're going to start with a little market update on interest rates. Josh, what's happened? So last week, just to recap here, we were having this conversation, and rates had been going up for about a week or two at that point. We were up maybe 0.25%. What are we seeing right now with rates?
More bad news, up another 0.25% or so. So for most borrowers, we're in the low threes. So to put it into context, we're still about 0.75% lower than where we were this time last year. Still very near historical all-time lows, but your conventional loans are in the low threes, and your FHA loans, depending on if you're needing a lender credit or whether you want a par rate. So 0.0 lender fees, you're in that 2.625, 2.75 range, and a standard balance conventional. Maybe you're clinging to 3 for the best qualified borrowers, high balance, and lesser qualified borrowers with 3 1/8 in that range. So terms are still good, very good, just not nearly as good as they were a few weeks ago. We kind of went through the technical charts last week. It doesn't mean anything to anyone else, but the weird thing that we're seeing is the selling should, based off of the technical charts, have already hit a bottom, and we should have recovered a little bit, meaning not going rates back as low as they have been, but better than where they are right now. So they're really struggling to put in a bottom. And you and I have talked about this before, that the worst time for us to try and figure out what in the heck's going on is the first year of a new presidential term. Markets are just confused as to what the new administration wants to do, what they're going to be able to do, and then once that happens, how it impacts the market. The big fear right now, everyone thinks with all the government spending that has been proposed and coming down the line, that we're going to see inflation. Inflation is the enemy of fixed income investments like bonds, mortgage bonds, and so rates are getting worse. So the rates should not be this bad. I am still of the belief that longer term, 1, 2, 3 years out, we're going to see even lower rates. But until the market is convinced that inflation is not a worry and the government spending is not going to be a problem, we're probably going to continue to see rates trend worse.
No, understood. And so with that, I have a question. So a lot of people are saying, well, higher rates, less people are going to qualify for houses. That means less buyer demand in some cases, which is going to cause inventory to rise. Market's going to shift, so on and so forth. So with that said, I realize you're small brokerage. You're not feeding the masses here with regards to, our sample pool here with what we talk about isn't going to include everyone, but how many people have you seen this effect where rates have gone up and these people are no longer in a position to qualify?
Not many. There's a few that are marginally qualified or we're already maxing them out. But for the most part, I'd say 70-75% of borrowers are fine. But it'll take a few out of the market, or at least take a little of the friskiness off of their offers. When rates are at 2.625, people are willing to get really aggressive, because we've talked about this a million times on the show here, that no one cares what the price is. No one cares what the price tag is. They care what the monthly payment is. You've seen this where car dealers don't put the price on a car. They put the monthly payment when they advertise it. Most times buyers buy homes the same way. So I think we'll definitely see some moderation in the overbidding. But you and I, had 3, 4, 5 offers, a couple for you and 2, 3, 4 others for other agents out this week. Everyone was multiple bidding. As recently as today, we had one of your clients and another one of our clients lose out in a multiple bidding situation today. And, were they the strongest borrowers in terms of the biggest down payment? No, but both of those borrowers were really well qualified, absent having a larger down payment.
Yeah, and that part's frustrating. Yeah, we've talked about it many, many times. It's frustrating for buyers. It's frustrating for agents, and it's just one of those things that you kind of, you write what you feel is an aggressive offer. but there seems to be somebody that is more aggressive in this market, and it can be hard on buyers to stay true to what they're trying to accomplish. So if you're one of those people out there, just know that you're not alone, right? It's a frustrating process for a lot of people. A lot of people are going through what you're going through, but understand you probably, again, we'll see some more selection with regards to inventory in the next couple of months, I would think, as spring starts to roll around, starts to get a little warmer, especially in some of these areas. I know we have people watching all over the country. I would think in markets where there's snow on the ground, it's really cold, houses probably don't pop up on the market as they would if it was a little bit warmer outside and you can have people walking through and so on and so forth. So I would think with spring, you're going to have some more inventory come in, which is going to give you more of a selection. It might not make it that much easier, but it should ease the pain just a little bit. So I know we have a couple of questions here, and Jen Lego, she's one of our moderators in the chat. So thank you, Jen, for taking the time to help us out with moderating. She is in Indiana, I believe, if I remember correctly. And she has a question. How important is it let's throw this up there, to choose a title company? Am I safe if I let the agent choose one less item on the list? I don't want to have the hassle of it. So typically, in a seller's market, what happens is the seller gets the opportunity in most cases, at least here in California. It's something, as we're writing offers for buyers, we're typically giving the seller the opportunity to choose the title company and or the escrow company, depending on what state you're in. And I would tell you that, letting your agent choose in most cases is probably to your benefit, because they're usually choosing companies that they know do a good job, that are efficient, that do what they say they're going to do. If something pops up, they can get things done in a timely manner. And a lot of times they have pull, right? So if there's, you need a reduction in fees or something like that because deals can't work, sometimes they can make that sort of thing happen. And they're typically going normally with the larger companies out there because, they're the ones that have the most support and the ability to do these things. So I would say that you're probably in good hands, letting the agent choose. Is there anything I'm missing there, Josh, on that front?
Well, what I would say, there's a little different angle from the lender side. Realtors generally tend to gravitate to a title account rep who's out in the field,
Sure,
that they have a good rapport with and that they know will go to bat for them. On the lender side, we deal more with the actual underwriter, and your underwriter, your title underwriter, is going to be the most important person in that transaction. So what we deal with is maybe there's liens on title that we have to clear. Maybe there's a cloud in the title, a deed that wasn't quite right, 10, 15 years ago. And getting a good underwriter that can underwrite around those is beneficial. And bigger picture, what most people don't realize is the title insurance, there's only a handful of title insurance insurers. So there's a lot of title insurance companies, but most of them are just getting their insurance from one of those 3, 4, 5 main underwriters. So for the most part, I prefer to be with one of the lenders that's underwriting, or one of the title insurance companies that's underwriting their own policies, so that if it comes down to it, they can make a decision to maybe write a riskier policy, riskier to them, not to you, because they're the one that would have a title loss, an insurable loss that they would have to cover. So the other piece of information, and Jeb, you pipe in on this. You've done this 20 years now. I got 26 years in this business. 2,000-3,000 transactions I've personally been involved in, and tons of realtors I've been around. I have heard of 2 title claims in that timeline. So do they happen? Yeah, they do. But for the most part, it's a pure commodity. There's nothing there that's important to a borrower, because it is highly unlikely that you would ever get into a title insurance claim.
Yeah, no, agreed. I've heard of one personally, never been involved in one, knock on wood. And in this case, it was something, I can't remember the actual deal, but it had something to do with a non-warrantable condo, and this was years ago. So yeah, they do happen, and that's why you have title insurance. But from the idea of buying a property, one thing one reason you have title insurance is to make sure you have a clean title upon purchasing that property. So if something were on there that they didn't get resolved or what have you, then that's on the title company. Doesn't fall back on you, but that's why it's more important to make sure you have a reputable company doing that sort of thing. Because, if you choose some of these smaller companies, that sort of thing, they don't have the insurance, they don't have the coverage that these bigger companies do, like the Fidelities, the First Americans, those guys. And if something really were to happen on, say, a multi-million-dollar luxury type property, it could bankrupt some of those smaller guys. And so, and most people aren't going to have to deal with that. And this isn't going to be an issue for most people. So we've kind of gotten long-winded on that, but that's a really good explanation as to the direction you should go. So
Jeb, you'll be happy to know that one of those two title claims that I've heard of was actually this guy. So I was fortunate enough to actually be on the wrong side of one. And again, it was with a large title insurer, and it was a fairly significant loss to them, but it was nothing to me other than working with them to work through the claim. They wrote a really big check to the city of Huntington Beach to fix a title issue with a condo that we owned here. And it just goes to the strength of being with a big major title insurer.
No, and that now I've heard of two, so we're tied. So here's a good question. Clean as Dirt asks, any tips on reducing capital gains on a rental property sale? Now, aside from the rental property, Josh has done a lot of flips on property that have had, gains, short-term gains, long-term gains, what have you, and had an opportunity where he's probably had to reduce capital gains. The one thing I would tell you that comes to mind right off the top is any improvements you've made to that property, anything you've done to improve that property can be something that you can use to reduce the amount of capital gains that you have. Outside of that, I'm kind of drawing a blank, outside of commissions and selling fees and that sort of thing that you're going to have with regards to selling the property. Anything
The biggest thing, and it really is just following on what you just said, is keep really good records. You want to document what you did, what you paid for it. And again, this is like everything else with the IRS. It only matters if you ever get audited. You could put down that you spent jillions of dollars and get your capital gains down to nothing or very little. But if you get audited, you're going to have to prove it. So the biggest mistake that I see homeowners and investors making is they do things that will reduce their capital gains on sale. They just don't document them. The CPA answer to this question is it's a mathematical equation. These are facts. What is deductible? What did you spend on deductible expenses? Or in this case, items that would increase your basis and decrease your taxable gain on sale. Those are facts. So it's not so much, hey, I'm getting ready to sell this house in a week or two. How do I reduce my capital gains? It's what did I do during my timeline of ownership that would maximize the taxable basis and therefore decrease the gain on sale.
And then the real obvious thing that you can do to reduce them is do a 1031 tax exchange, right? So that allows you to take that money, roll it into another investment property of like kind, and essentially not pay any capital gains taxes. So I'm assuming you probably know about that, but I think Josh answered the other part pretty well there.
Jeb, what I would say about that 1031 is government's real eager to shut that down. We've had the 1031 since the early 70s, mid 70s, and it's a very good tool for deferring gains. The government will eventually get their money. For the most part, but even that with inheritance guidelines and estate guidelines, there's some ways to shelter it all the way through. But if you're thinking about liquidating some property and you have some significant gains and you might want to do a 1031, I would absolutely advise doing it sooner rather than later. Market's crazy right now, so that can impact that decision. But just we have big uncertainty going forward of how long the 1031 tax deferred exchanges are going to be available.
Yeah, that's something I read that Biden wants to get rid of, and honestly, it has a lot to do with our former president owning a lot of commercial property, and I mean, he's not alone, right? There's a lot of people that do this sort of thing, but I think they're trying to make a poster child here of removing that capital gains. But anyway, so it's me, C says 23 viewers. We have 56 now. So thank you. 8 likes. So guys, hit that like button. Like C said, we would appreciate it.
I like her style.
Hey, absolutely. We like that. Let's see what we got here. So if you see something, Josh, hit it.
Well, here, this is a question you're going to want to answer, but I'll throw it
There
up
you go.
there.
All right. So how does rent back work when purchasing a home and letting the seller live in the property? Some include 30-day free. Can you elaborate what you're seeing out there? So what I'm seeing out there right now is basically anything that will get somebody into a house. We're seeing a lot of 30, 60-day rent backs. In fact, I have a client right now that allowed the seller to stay up to 60 days rent free as part of his offer. It was part of a counter offer that we submitted, and that kind of, we used that to help us stand out. I would say what's typical though isn't free rent in most cases. In my career, most of the time when you allow a rent back, you're asking the homeowner, the former homeowner of that property, the seller, to pay the principal, interest, taxes, and insurance and HOA of what your payment would be while they stay in the property. And essentially there's a form that gets filled out whenever you stay in a property longer than 30 days here in the state of California. There's a certain form that has to be filled out that essentially says that you're staying in that property for a period of time. And you almost have to do a short-term rental agreement during that time, just to cover yourself and your brokerage and what have you with that. But I would say 30 days is pretty normal. But right now, because there's a lot of sellers that are contingent on selling their property to purchase something else, buyers are saying, hey, look, let's do it this way. Let's close on the property. I'll allow you to rent back for whatever period of time you need, so that I can at least close on the property, guarantee my rate, guarantee that I'm able to get into a home, and then you take X amount of time and find that. But understand, and Josh is probably going to talk about this from a lending standpoint.
So let's close two loops on that.
Yeah.
The reason why we're saying 60 days, you're not hearing 90 days, 180 days, is most people are buying the home to owner occupy. They're getting owner occupied financing. As a part of that, your occupancy affidavit that you're going to sign with your loan document says you are going to move into that home as your primary residence within 60 days of closing. So if we have a written agreement as part of the contract that says you're not going to move in within 60 days, then we can't do owner occupied financing. So that's the reason why you don't see much more than 60 days. It would require either someone not getting financing or someone buying it as a rental and allowing you to stay.
Or someone buying it as a primary and saying, we're putting 60 in writing, you just stay whatever you need to stay so that we get this done, which does happen, by the way. All right. So that was a good question. So Mr. OG Thomas, I like OG better. OG Thomas, do you think rates will continue to increase? How will this impact housing sales? So Josh talked about rates a little bit at the beginning, but I'll let you just kind of answer a short version of that question to help people get an idea here.
Without getting too geeky on it, I always like to tell people, and I'm paraphrasing someone else, I don't know if it was Charlie Munger, Warren Buffett, that says, if something can't be true, it won't be true. So we cannot have rates significantly higher. When Obama took office, there was $7 or $8 trillion national debt. We're hitting close to 25, and we're going to be at 40 in the next 5-7 years. So you go from 7 trillion to 40 trillion across multiple presidencies. Every idiot in Washington, D.C. thinks it's okay to spend future generations' money. And there have been a couple of big things that have happened in those timelines where money had to be spent, but we haven't had to spend nearly as much as we have. But long way of saying, imagine you had a credit card with a $7,000 limit and you had it maxed, and somehow it got put up to a $40,000 limit, and you again got it maxed, but you got to set the rate on that credit card. Rates would never go very high. That's what the government is able to do. They're able to manipulate interest rates to keep them very low, to keep debt service on that soon to be $40 trillion national debt very low. So where the absolute cap is on treasuries and then therefore mortgage-backed securities, which they're manipulating, they're buying both of them right now and will continue to. My guess would be somewhere around 3.5, maybe 3.75 on the high side. We're not going back to 4%. A 4% mortgage rate would tell us that the 10-year treasury is at about 2.7%. That would be double what it is right now. So you would be looking at doubling debt service on the national debt. The U.S. government cannot afford that. So if it can't be true, it won't be true. Can they go up? Are they likely to go up more? Yes. Over the long term, they're going to continue going lower because the government needs them to go lower.
So what about the second part of that question, Josh? How will this impact house sales?
Hopefully it slows them down. What we've seen, FHA index came out and the Case-Shiller index this week, and they both showed year-over gains in the double digits, 10, 11%. You and I had talked about the American Enterprise Institute saying they were projecting 10% for this year and 9% for next year. That's not healthy. It's great if you own a home and you're going to sell it and you just want to spend the money. But if you need to buy another home, if you're trying to get your first home, it's not good. Homes rapidly become unaffordable. A lot of you are seeing that and pointing that out now. So hopefully a little spike in the interest rates will just take away a little of the booze from the punch bowl so the party can go on a little longer. I would love to see 4 and 5% gains this year and next. So in a perfect world, that's what we're going to see. Nothing about these higher rates is going to shift it over to a buyer's market. We have way too many buyers out there and way too few homes for sale. And everyone I've talked to, Jeb, it was an agent, a listing agent on one of your clients' homes. Talked to her the other night, and she's talking about she has 7 listings coming up in the next 2 months. People moving out of California, 4 of the 7 moving out of California.
Wow.
3 of the 7 moving to the Inland Empire for lower prices, wanting to cash out a little bit of that home equity, get a lower price. But that's 7 more homes coming to the market. You're like, okay, she had 15 or 20 offers on that property. So what? What if she had 7 right now? It just means there'd be 2, 3, 4 offers on all of them. So does it moderate the crazy appreciation? It does. We're just not going to have enough coming to market to really help much. So hopefully we get more of a balance and it's less of a seller's market, but it's going to continue to be a seller's market.
There you go. OG. Jennifer here. So Jennifer had a rate in the 6.75, says she won't complain about anything under 5. So yeah, those that have been around the block for a while have had higher interest rates and are looking at the rates now thinking, rates are still great, regardless if they've gone up a quarter or 3/8. The other side of that is you've got the people that are first-time home buyers, never owned a home, and they're looking, they got in the market and rates were mid 2s or mid to high 2s, and now these people are freaking out. So it's just
Jeb, I had a listener from the show that we're working on. They had agreed to pay $100,000 over what we agreed it was likely to appraise for. And we were trying to figure out a way to structure it. And we had a unique structure that was going to give them a first and a second rate. And it was going to end up at a blended rate of 3.22%. And she said, I'm just not moving forward with an ultra high rate like that. And you're like, oh, I don't know what to say to that.
No, absolutely. John. So John is asking, how often do you represent both the buyer and the seller as a listing agent? Do you have a lot of buyers coming to you directly trying to get a better deal or win the bidding? So I would say I don't represent that many buyers and sellers. Dual agency, it's what it's called. Depending on where you are in the country, you may or may not allow it. Your state may or may not allow it. Quite frankly, I don't agree with it. I don't think it should be allowed just because there's a lot of ways to manipulate and do things that I don't feel like are ethical in that case. But me being an honest and ethical person, I feel like if I do it correctly, but there's a lot of people that don't. So sounds a little self-serving there, but it's the truth. But what I will say is that, the last couple of deals I've represented as far as selling them, being the listing agent, I said from the get-go, I won't represent any buyers on these transactions because I know going into it that there's going to be 15, 20 offers, that it's going to go above the asking price, that there's going to be this bidding war. I don't want to be involved in that. For one, because if my client actually won, every buyer and buyer's agent out there looks at me like I gave my buyer the information to get the transaction done, which, quite frankly, I mean, it wouldn't have been true, but that's the way people perceive it. And secondly, it's just one of those things that, in order to best represent your client when you have multiple deals like this going on, it's better to just, in my opinion, better to represent one party. And I'll have realtors tell me I'm crazy and what have you, but that's the way I follow it. Have I done it in the past? Sure, I probably do. I sell on average about 30 homes a year by myself. And so out of those, I would say 1 or 2 is probably dual agency. And that was prior to what we're going through now. And so, typically those aren't situations where there's 15, 20 offers in those cases. So, but I do have people reaching out to me trying to get a better deal. I don't negotiate with terrorists. being serious, I don't use me being the listing agent to help somebody get a deal. In most cases, I'm willing to work with people, but if people come to me initially trying to say, hey, I want a deal because you're the listing agent, then I'm probably not the guy. You need to find another agent that's willing to do that, because I'm there to represent you, to get you the best deal I can, the best house at the best price. And I'm willing to work and negotiate and do things. But you have to understand, I mean, it's not just me giving up commission in order to do that. So, but that's
Jeb,
a conversation.
One of the things that you and I have talked about on here frequently is the importance of the lender following up on the offer and just trying to put the agent at ease that it's a really solid offer. So I have a lot of these conversations with multiple bidding situations, and most professional agents will go out of their way to tell me, we have X number of offers. I am not representing any of them, just because obviously it would represent a conflict. So I wanted to throw this one up here. We've all seen and heard this somewhere through the years. So dual agency, it's not possible. I can't represent your best interests and someone else's best interests. I can mediate, I can moderate, I can come to a decision. So if we're talking about Jeb and I have a same-sex marriage and we're getting divorced, someone could mediate and find a middle ground for both of us, but no one could win for either one of us. And it's not that real estate is about winning, but it is important that each side have an agent representing their best interests, because I don't know, Jeb, you tell me, what would you say 2/3 of transactions go relatively smoothly where there's nothing contentious to negotiate, but at least 1/3 of transactions, through the fault of no one, these are unique houses, unique transactions, something comes up that is open for debate, and each side wants something, and they need an agent negotiating for them. I would just say the last thing that I would say on this, if I were listing my house and an agent who was listing my home for me brought me an offer that they were representing, I would probably try to just get out of the listing agreement. There's no way you can do that. I have people, I trust Jeb implicitly. Jeb couldn't do that. No person could sit there and have 20 offers and then have one that's going to get a double commission for them and make it work. It's not to say that there's not a way, but again, it all comes back to, it's more of a mediation or an arbitration versus representing me and representing them.
No, I mean, that's the truth. And I will tell you that this is a really good example of a case where I said I wouldn't represent two sides. I told the guy that. He came to me directly. And I said, you know what? I'm not interested in representing two sides. This was years ago, maybe 2 or 3 years ago at this point. And he said, he told me the price. I forget. I think the house was listed at $550 at the time. Believe it or not, there were homes listed at $550. And he told me at that time, he's like, I want to make an offer for $600,000. And I said, I'm willing to represent that, because at the time, I think the property was listed at $550. And so I knew that his offer at 600 was a strong offer, that would be a great offer for the seller. And I didn't tell him where he needed to be, and he didn't ask me what the best deal on the house was. That was the price he was willing to make. He didn't want me to negotiate. That was an easy one, but that's not normally the case. Most of the time, the buyers want the price at a deal. The sellers want the best price. It's very hard to navigate both sides or serve two masters, as Josh said just a moment ago. All right. What do we got here? So here's another question here, Josh, that you can answer from OG. Hey guys, one more question. How soon after receiving a conditional approval can you close on a home?
It really depends on how gnarly the conditions are. For the most part, 9 out of 10 of our files are going to come through because we've packaged them right on the way in. It's just connecting the dots on a couple of things. So it means us getting that conditional approval, reading through it, and reaching out to the client for anything that would come from them and how quickly they can get it back to us. So let's say, perfect world, there's 3 to 4 conditions, a couple from escrow, a couple from the borrower. We have all of them in 24 hours. You're generally talking about 24 to 48 hours for the underwriter to review and clear them. So probably 3 to 4 days to get loan docs, and then another couple days to close. So you could close within a week of getting conditional approval, but it's also not uncommon that it to be 2 weeks after getting the conditional approval.
Awesome. I saw a good question. There's actually a couple good questions in here, but this one pops up, so I want to have you answer this one, because this is one I get asked all the time here. Do medical collections on a credit report matter to a lender?
They're looked at differently. So the medical collections will still impact your credit score. So they matter in that they're reducing your credit score. If we still get an approval, they should be fine. On conventional loans, the automated underwriting system will tell us whether they care about any type of collection, and they don't differentiate between medical or otherwise. So most times, unless it's a monstrous amount of collections, it won't become an issue. So if there's a handful of medical collections, generally not a problem. FHA has a different requirement. Collections in excess of $2,000 are going to require to be paid off, or we have to use 5% of the balance against you in terms of payment. So it can impact your qualifications. So it's not like a medical collection is a get out of jail free card. They do look at them differently. They know that medical collections happen. If you have a big surgery or a car accident, there can be a flurry of them coming in. They go to the wrong address. Insurance was supposed to cover them. What I would say about medical collections, it's probably the most important, that is the closest to a get out of jail free card, is that 9 times out of 10, the collection agency will delete the collection from your credit report if you pay it. So if you can get your insurance company to pay it, or if you agree that you owe it and you're going to pay it, we can generally get those deleted and have a fairly large impact on your credit score. Because it's not uncommon that we get borrowers with perfect credit and 3 or 4 medical collections from an event like we talked about, just something weird that came up. If we can get those off of there, the scores will go up immensely, and it's usually going to get you better automated underwriting findings with less documentation, possibly an approval at a higher debt to income ratio, but it's absolutely going to get you a better interest rate.
And one thing to keep in mind with that, and Josh can talk about this too, I don't know if this has changed, but if you are planning on paying off those collection accounts, have that conversation with the medical collection company up front and tell them that you want proof that that's going to be removed, excuse me, from your credit report, and see if they'll do that and provide letter of, some sort of documentation to do that. Because if you just pay it off and then try to go back and get them to send you this information, you might not receive it. So, and you really need that documentation from them stating that they'll delete it, because if they say they'll delete it and it never comes off, if you have that proof, you can always send it to the credit bureaus, or at least you could in the past, and have those removed, assuming the documentation is correct. So,
yep. So you get in writing from them, have them fax or email you documentation that says we are agreeing to accept X as payment in full, and we will be deleting from all 3 credit bureaus, all reporting from all 3 credit bureaus, and they'll put a date on that. They're not going to leave it open-ended. They'll say if it's paid by March 7th. So then when you pay it, exactly what Jeb said. If they don't go ahead and delete, you have the documentation that said they would be deleting, and then the proof that you made the payment.
All right. So Dahl has a question here. Dahl. I'm selling my house, have it for 3 years. I know there's a tax break on the first $250. Is the profit calculated after seller's closing fees, or calculate on selling price? So we talked about this a little bit a moment ago, but we didn't really go into detail. So what he's asking is, when you sell a property, if you've lived in that property 2 of the last 5 years as your primary residence, and you haven't sold another primary residence within the last 2 years, you get up to $250,000 of tax-free gains on that property as an individual, and up to $500,000 as a married couple. So in this case, I'm taking it that you're single, Dow, and you're 250. So what happens is that 250 is calculated after you say the selling price, commissions come out, closing fees come out, any improvements you did to the property come out. Your gain is based on what's left. So we could do an example if you wanted to run through it, but I think that pretty much explains it. Yeah.
Yeah, the key concept, and it's a detailed one to get into, is your basis. So when you purchase a home, that is your basis. On a primary residence, you're not depreciating it, so you're not reducing your basis. Improvements can increase your basis, and then there are additional expenses, including, let's say you refinanced last summer and someone talked you into paying 2.5 points for the UWM 1.99 interest rate. Those points would be deductible against that sale. Also, also will reduce that cost. So you just have a few things to work through, and the best thing to do if you're going to be doing that and you're questioning if you're going to go over the $250,000 limit, talk to your CPA. They can walk you through it exactly. We're just we're well versed in the rules, but no one knows that like a CPA does.
No, agreed. All right. Here's a good one. John, we've answered a question from John a moment ago. Is APR a good or bad way to compare lenders?
So the first question on that, Jeb, is what is APR? Most people have no idea what it is.
Well, it's a low number. It's my interest rate. It's my monthly payment, right?
Yeah. Yeah. So the most common misunderstanding that we get, people say, hey, you said my rate was 275. I just got this and it says my APR is 2.82. Yes, that's correct. Why is my rate 2.82? The rate is not 2.82. So the government made APR as a means for you to be able to compare between multiple lenders. And that's John's question. Is it good or a bad way? It's not the best. And the reason is it can be manipulated. If you read the guidelines, it's very clear. Let's talk about how APR is calculated. Let's say if you borrow $300,000 at 3%, if you paid no loan costs, your APR would be 3%. So the APR is called the annual percentage rate. It's meant to allow you to compare different loans based off of what the costs are there. So any points, any fee that is called a prepaid finance charge, which some costs are and some costs aren't. What they do to arrive at APR is, let's say you had $3,000 of prepaid finance charges. What they do, they would take your $300,000 loan, take away $3,000 because they're saying you're only getting loaned $297 because they're charging you $3,000 for the loan. And then with your monthly payment on the $300,000 loan at 3%, what rate does that equate to? So it's going to give it a little bit higher, 3.1, 3.2. So for the most part, on purchase loans, the only thing you need to know to compare is to look at the interest rate and then to look at box A on your loan estimate and then on your closing disclosure. Box A are all of the things that your lender controls. Just had this with a borrower last week. They had been pre-approved by Quicken. Quicken had promised them, we're not charging you any points, we're getting you 2.5%. And interest rates change day by day. But magically, they get under contract, they come back, it's 2.875 with 2 points, which was just crazy. So I told her, I said, this is all you have to do. Get a loan estimate from them. I will send you a loan estimate as well. And the only thing we're going to compare is what is the interest rate and what's in box A. So for box A, they had $14,875. At the same note rate, 2.875, we had $3,200. It was a pretty easy decision for her which one of those was better. Well, we also just said, would you also like me to bump the interest rate to 3%? And now you have nothing in box A, and she's actually getting a $2,000 credit towards her closing costs. She goes, yeah, that's a lot better. So covered kind of two birds with one stone of how to compare. And the reason why I say that's important, or that's the best way to do it on purchases, on a refinance, the items in box B and C also can be controlled by your lender, but for the most part, they're going to be pretty similar. Every big lender, a Quicken, any of the online lenders, they do a lot of business with their escrow and title divisions, so they've negotiated those to a very low fee. I do a lot of business with my title and escrow company. We've negotiated a very low fee. So there shouldn't be much variance, but we do control those. And I've seen, the worst one, we saw a loan estimate come through last year and the numbers sounded good. And they told us what was in box A and they sent it over and they were using an escrow company that was charging like a purchase escrow fee on a $400,000 or $500,000 loan. We have a flat $450 for the escrow. This was like a $1,800 escrow fee. So it can happen, but for the most part, even on refinances, look at the interest rate and look at box A. Those are the two things. Box A are all of the charges that your lender or your broker charge and can control. So admin fee, processing fee, underwriting fee, any discount points, origination fee, all of that shows up in box A.
And another thing I'll add to that, John, too, is rate's important, fees are important, but you also need a lender that understands what they're doing, that can explain to you what they're doing, why they're doing it, someone that picks up their phone, someone that gets back to you, emails you. Yes. I mean, most lenders these days are going to probably be within 1/8% of each other for the most part. Fees are probably going to be pretty close. So when looking at two, it's hard for me to sit here and tell you don't worry about 1/8% or a couple $100 here or there, because I know that, like, for example, if I'm a real estate agent and you're using, say a big box lender, main lender, whoever you can think of a bank, and you're using, say, my lender, in this case would be Josh. The rates might be pretty similar, but I can tell you one thing: the loan will get done a hell of a lot faster, way more efficient for everybody involved if you use the broker in this case versus the big box. So, don't just look at fees and rate. Look, kind of read between the lines, if you will, and compare the two, right? And see what you get.
Yeah, and what I always tell people on both sides, what you just said, everyone should be within about 1/8%. Every reputable lender literally should be within 1/8%. But if you see an outlier on the high side or the low side, it can be tempting to go, hey, this guy's 3/8 lower than the 5 other people I talked to. Guess what? There's no magic out there. There is no magic. So I would be very skeptical about anyone on the low side, and obviously and easily skeptical of anyone on the high side.
All right. Benjamin's got a question here, to both of us. Due to low supply, high demand, and the house being overpriced, would you guys ever personally buy a house that is selling for more than it's worth? I'll let you go.
So worth, I'm going to imply or take that to mean what it would appraise for today. So that example that we just gave, we have a client that's going to be buying a home. They know it's 100,000 over what it will appraise for. Could I give you a scenario where I would? Absolutely. I wasn't in the market recently, but Jeb and I, there's a house right around the corner from him that I drove by about 87 times and told him about 115 times because it was an awesome location. And there's probably not ever going to be another one that I would like that location as much. If I had truly been in the market and ready to sell my house and move, and if that was $50,000 or $100,000 over market, which in this case would be 3 to 5%, I absolutely would, because there are properties are not like cars. If you want to buy a red Accord, you would never overpay for a red Accord because there's thousands of them that you can go buy. Houses are unique. The location, the layout, the design, any number of things could make you be willing to overpay for it. I just would always want to have my eyes wide open going in. This is what it's going to appraise for. This is why I'm paying more. This is why the market is not saying it's worth that much. But in general, if you're just out making offers and every house is going for 20, 30, 40,000 over list, I would actually say that in that situation, that is more an indication of value. When we do an appraisal, the appraiser has to look at it from 3 directions. They say, what is the cost approach? So how much does it cost to build it? The income approach, how much income will this generate? But for the most part, 99% of the weight is put on the comparable sales approach, which what are the most recent sales in the neighborhood relative to this one? And it gets really hard in a hot market like this. What I can say is, to date, in this crazy hot market with homes going over value, we have not had a problem on an appraisal. My guess is in the next 3 to 4 weeks, I'm going to have a problem on an appraisal. The appraisers have done a good job of realizing that when there's 20 offers in on the only home for sale in that neighborhood, those offers are a better indication of what the home is worth than what the last sale 3 or 4 months ago was. So I don't know. What are your thoughts, Jeb?
No, I mean, I think I was going to actually start my little rant with that is, regardless of what you, Benjamin, myself, Josh, anybody thinks the house is worth, it's worth what somebody's willing to pay, right? I mean, a perfect example is I have a house listed right now for $990,000 here in Huntington Beach. When I met with the sellers, I don't know, 2 months ago, the market was hot at that time as well, but we talked about pricing the property. My suggestion of what I thought it was worth was less. Let's say 10% less at that time. And, but I said, hey, listen, in this market, you have no idea. There might be somebody willing to pay it. And I'm willing to put it at whatever price you want to list it at. It's your house. And let's see where it goes. And we have 3 offers at this point, all above the asking price. So, 2 months ago, there weren't comps to support that property, the list price, but now you've got 3 people willing to overpay for that property. In your case, overpay for that property, all with no appraisal contingencies. So, it's hard to say at this point what something's worth, because people are doing things that we haven't seen before. Now, with me overpaying for a property, if we're using the same example that Josh did, yeah, I would overpay, but obviously there's a limit on that, and it would be, look, it would have to be the right property, right? My wife and I right now are in the position where she's looking every day for something out there, and if the right property came on the market now, in where we want to be, chances are we would probably do what needed to be done in order to make that happen. So yeah, to answer your question, I think I know I would. It would just have to be the right one.
Jeb, let's throw this one up here. It's a good question. I think it comes up a lot. A. Enriquez 87 says, can you explain in detail how a rate lock works? Exactly what point in the process it's available and for how long typically? So start with the second part, because that's really easy. At what point in the process? As soon as you have a property identified, you can lock an interest rate. For the most part, about 180 days is as long as you can do. In practical purposes, I've never in 26 years of doing this locked a loan for longer than 60 days. So in terms of looking at how a rate lock works, in essence, the lender is saying, we will insure you against higher interest rates for a period of time. The most common terms are 15 days, 30 days, 45 days, 60 days, 90 days, 120, 180. What happens is the lender has a pretty strong feel of what's going to happen for the next 15 to 30 days. So the cheapest rate locks are 15 and 30 days. Once you go to 45, it's a little more expensive. And from 60 on out, it's considerably more expensive. And the comparison I give people is, if you've ever shopped for term life insurance, I'm 47. If I want to go get a 10-year term insurance policy, it's pretty cheap, because most people that are in good health don't die before the time they're 57. If I want a 30-year policy that insures me out till I'm 77, a lot of people die before they're 77, and there's going to be some losses to that insurance company. They're going to charge me a heck of a lot more money for that. So again, 15-day lock is the cheapest, 30-day lock would be next, and so on and so forth. The longer you want to lock, you're buying more insurance and it gets more expensive. So when we decide to lock, why? What can happen? On any given day, only 3 things can happen with interest rates, and 2 of them are good. They can stay the same, no big deal, no harm, no foul. They can get better, I'm happy, or what we've had for the last 2 weeks, they can get worse. So basically that rate lock is insurance against the one outcome that can be bad. So for most loans, most people don't have a high risk tolerance. They like certainty and they don't like things changing. Right. And when rates go down, they go down slowly. And when they go up fast. We took 10 months to get down to where we were, and it's taken 2 weeks to get back up where we were 6 months ago. So for most folks, if you're within 30 days, the difference between a 30 and a 15-day lock is insignificant. If you're within 30 days, get it locked and take that stress off of your back, unless you're very confident that rates are going lower and you're comfortable and you have a high risk tolerance level. If we're looking at a longer lock, 45, 60 days, I have a client that's buying new construction right now. It's not going to be done for some undetermined amount of time, right at about 60 days. Within another 2 weeks, we're going to start considering locking. And if rates get much worse, we might do that longer term lock, but it would be ugly and painful to do a 60, 75-day lock for her right now. So we're just keeping an eye on it, making sure the current levels of technical support hold. And if they do, we'll try and get it closer to within 30 days. So hopefully that was a decent explanation, but really a rate lock is just insurance against higher interest rates. Probably the last thing I'll close with, people always ask, well, cool, I want to lock. And if rates go down, do I get the lower rate? And the answer is no, you don't get the lower rate. You are locking the rate. Are there brokers who will pick up your loan and move it somewhere else if time allows, if rates were to move? Yes. If we have a big move down in rates, can lenders sometimes renegotiate? Yes, but you won't get all of the gain to the downside. And then the last thing is, are there lenders that advertise free one-time float down? Yes, they do. And they're not the lenders with the best rates to begin with. So in essence, you're paying a slightly higher rate to start with for the potential to be able to float down later on.
Great explanation, guys. That you should you should know more than most lenders at this point if you took that in. Georgina is asking, hey guys, what are some of the ways to work with quote unquote influence appraisers? Our biggest issues are comps, and they always seem to be lagging behind a few 100,000. So I believe, if I remember correctly, she's up in the Bay Area. So I'll start by saying there's not really a ways to influence appraisers these days, right? So back in 2007, 2008, we got to pick appraisers when we wanted to, have a property appraised. That led to a lot of the debacle that happened because properties were appraising at values they probably shouldn't have been. People were getting money lent at 100% financing to these amounts that were, above where they should be, and so on and so forth. So now there's something called appraisal management companies where all appraisals are basically appraised for the most part through these appraisal management companies. We, as real estate agents, I think lenders as well, Josh can verify in a moment, that we don't have contact with these people for the most part. They call us out. If I'm the listing agent, they'll call me to schedule an appointment. And as the listing agent, I'll show up to that appointment with the comps of that property in order to try to support the value that, where we went into escrow. And if there's 50 offers, I print out 50 first pages of a contract to bring it along to that appraiser to say, hey, look, this is where we priced. This is the amount of demand that we had. And I try to answer their questions in the best way possible. That's the only way that I think we can quote unquote influence. Now, if you're a buyer's agent, you never really have contact with that appraiser, right? It's typically with the listing agent in most cases. So, you hope that the listing agent on that side is doing the right thing and trying to get that property to appraise so that their seller, for one, doesn't have any issues with the appraisal and what have you, and is still doing those things. But, that should be something that, if you're having issues with appraisals, make sure if you're on the buy side, ask your realtor, hey, look, can you reach out to the listing agent to see what they're doing to try to do that? And they might be able to answer it without calling out, but there's not a lot that can be done these days. And quite frankly, I'll be completely honest, I don't know how some of these appraisers are coming up with the values that they're coming up with right now in appraising these properties. Typically I know how appraisers work. I've seen 1,000 appraisals in my lifetime, probably more. And I've been on the side of what they call broker price opinions, BPOs, when selling foreclosures. And I basically have to do appraisals on property and essentially go through it the same way an appraiser would. And, it's based on condition and location, lot size, bedroom, bathroom counts, all of these different things and the features of the property. And you're giving those things value. And if you have a comp that is of higher value, you're deducting things from that comparable to, to basically come up with an idea of what that property is worth. In this market, I'm unsure of how they're using properties that are selling well above and beyond. I don't know what they're putting in the remarks there to get it to appraise. And Josh, you could probably touch on that. I don't really see appraisals anymore these days because they're not really sent to me. It's more, hey, look, the property appraised, and we're like, great, thank God, and we move on. We don't ask any more questions at that point. So
honestly, the market's been so crazy and we've been so busy that I look at them when there's a problem, and we start trying to figure out how the appraiser was wrong. We haven't had any that have been a problem yet. Like I said, the overbidding really accelerated the last 2 to 4 weeks, so I expect we're going to see a few issues. But in this instance, there's not a lot you can do to argue with an appraiser when there is not another comp available. What Jeb said is exactly what I always advise listing agents when we get a property under contract. As soon as we order the appraisal, I reach out to them and tell them exactly that. Please show up. Please provide them all the comps. Please tell them everything unique, interesting, amazing about this property. And please, for the love of all things holy, give them the first page of every contract, of every offer you have, so they can see how much demand there was for the property. Because that's really the only thing we can pin these values on, is saying, hey, there's 15, 25, 45 people willing to pay this price for this home. One of my girls here in the office, her daughter is buying a home right now out in Temecula, 50 offers. They're one of the final 4, and now they're in a counter to see which of those 4 gets to win it. I mean, that's nuts. And what I would say, there's another couple questions here that I would love to jump into that kind of piggyback off this and ratchet around the same thing. In 2004, 2005, when we last saw this type of stuff, it was different. It was different that we had liar loans. Everyone who was willing to pay X for the property could be in the game. So remember that all 50 of those people have a lender saying you can qualify to buy this home. So it's not just make it up. It's not just, hey, I'm willing to buy that home and now I am able to. They are willing and able to buy. So where I want to kind of transition.
Well, I want to add to that real quick while you're on that thing, is that one thing, keep in mind. So one of our recent clients, actually a buddy of mine, Josh ended up doing the loan, super well qualified buyer, right? But he was going through the process and they're asking for documentation of things that is required in this market, but again, super well qualified to the point where, like, you know, he's on the other side getting frustrated because they're like, why do you even need this stuff? And so the reason I'm saying this is because it just shows you how in depth lenders are going and the detail that they're doing to make sure that these buyers are legit, that they, you know, that everything is documented, you know, and if you were around back then, or if you're going through the home buying process now, you know that. But if you were around back in 2007, 2008, 6, whatever, there was none of that. I mean, you know, you could make phone calls to your account rep and say, hey, can you get this condition removed? And lo and behold, the condition would be gone and somebody would have a loan. And, you know, here we are today. But anyway, I'll let you jump in back in that, Josh. Sorry.
No, it's good, and it's absolutely true. So all these people qualify. The guidelines are, for the most part, written in stone. We can only influence underwriters to the fact that we know the guidelines better than they do, and that the guidelines are our borrower meets the guidelines. In the instance of Jeb's borrower, from the borrower's perspective, he's like, I am very well qualified. You guys are asking me questions about large assets, large deposits into my account. Why is that a problem? Without going into why it's a problem, it's not a problem. It could be a problem, and the lender makes us prove that it is not a problem. So if that's it, that kind of closes the loop. There's many times when we're asking for things and the buyer says, that's stupid. Why are you asking for it? It's not stupid, but you have to step back and go, how could that be a problem? So a large deposit to your bank account could be a loan. So generally, the underwriter is going to say, what was that large deposit? Show me where it came from. So it can be a bonus. It can be a gift from a family member, and different assets, the different ways that those funds come to you may or may not be usable. You could have gone out and taken out another loan, and now we have something that is not usable for down payment and probably has a repayment term attached to it. So just same stuff Jeb was saying. But where I was going to transition from Georgina's question is, Sun Lee says, with house prices increased 15% in the Bay Area, do you think home prices will go down with increased rates, given that the average person cannot afford such high prices for a single family house? The important thing to know there is it doesn't matter if the average person can afford a single family house. It matters, can one person afford it? And what we're seeing, that same example, homes in Temecula, 50 offers on that property. Let's say rates shoot up and only 20 people qualify to buy that home. Does it make that price come down? No, it's still going to go up, and it's going to go up just as much as it did before. So at a certain point, you're absolutely right. We've been talking about this. We're up 10% year over year. We're projected to be up 10% in the next 12 months and probably 10 the following. If that happens, yeah, we hit a point where those 50 people, maybe 8 of them qualify. So it self-corrects at some point, but just because rates went from 2.75 to 3.25, it's not going to make a big difference. That difference, Bay Area, let's say it's $1.5 million house, 0.5%, it's $400 or $500 difference in a monthly payment. Do most of those people still qualify? Yeah, they do.
Right. No, good stuff. Jonathan has a question here. This one's a little bit, it's up in the thread here, but I want to put it up here because I think it's good. Liquidating stocks in my portfolio for my down payment. When is the down payment usually due? end of closing. Also, I'm assuming I need an audit trail to provide to my lender. So you just kind of mentioned this, but I'll let you take this and run with it because it's something you deal with routinely.
Yeah, and currently the market, since the big downturn right when COVID jumped off, has been on fire. So people are like, I don't want to take my money out until the very last minute. Say, okay, talk to your broker, talk to wherever you have your funds at, and say, how long from me putting in the sell order do I have the funds in my account? That's what you want to find out. So in terms of when is the down payment usually due, your deposit that is part of the contract, I agreed to a $10,000, a $25,000, a $250,000 deposit. The
Earnest
deposit,
money, whatever you refer to it as.
yeah, your earnest money or your upfront deposit, that's due usually by contract within 72 hours, sometimes sooner of getting under contract. Now, the remainder of your down payment funds and closing costs, they can come screeching in at the very last moment. I don't advise that. We hate sitting here that the lender is ready to fund the loan and we're saying, hey, where are buyer's funds? In a perfect world, you have your funds to escrow 48 hours or sooner prior to close. When you sign your loan documents and you see your estimated settlement statement, you agree that's how much I need to send in, probably just set up the wire and get it over there. I mean, Jeb can talk to this. If there's still contractual issues that you're waiting for some repairs to be done or some stuff like that, you don't want any more money in escrow's control than you need to. But assuming we're at the very end, everything's clear and we're trying to close, get it in at least 48 hours prior to close. And in terms of the paper trail, you're 100% correct. We're going to need documentation of the sale of the asset, so to show what the proceeds were, so we can show, hey, I had $700,000 of Tesla stock. Well, cool. How much of it did you sell and at what price and what did you get? Now we've documented the funds and then we document the transfer. Some brokerage houses will wire directly to escrow for you. Others will say, I got to send it to your bank account and then you have to send it on. So every one of those steps you need to document.
No, good. So John has another question here. We'll jump to Michael's question in a moment. So John is asking, how often are you seeing homes appraised for more than the purchase price? So rare. Typically, appraisers bring in properties at market value or whatever the purchase price is. Rarely ever do we see an appraiser really shoot for what the home is worth in this market, because it's not needed in order to close the transaction or get the money, the lender to lend the money to the buyer. So they're just going in at appraised value. So rarely ever are you getting somebody that it actually appraises it for.
And think about where the market's at. Last year, I think we had a couple of them, not much. I mean, 5,000, 10,000 over asking price. One of them was a family member gave someone a sweet deal on it, and the appraiser brought it in closer to what the fair market value was. But in the current market, where every home is selling at top dollar, no, right. There's no one's going out and saying, hey, it's worth even more. But in a normal market, it happens. It doesn't happen often, and it doesn't happen by much. We've had ones where we know that sale is $50,000 low, and the appraisal doesn't come in 50,000 over. It comes in 5,000 or 10,000 over.
All right, Michael, I'll get to that question in just a second. Jennifer, thanks for pointing out Juan's question here. Would an offer with a strong down payment, 20 to 30% be more advantageous compared to an offer that is 15 to 20,000 above the asking price? Depends on the seller. I would say in most cases, no. Most sellers, in my experience, are interested in how much money is the property going to sell for. So if somebody's willing to pay $20,000 more than the next guy, assuming the financing, again, this is kind of a multi-layered question. And part of it is the listing agent doing their due diligence to make sure that the higher offer loan is still a doable loan and not risky for the seller to take. But if I had, for example, somebody that was putting, let's say 10% down, but going 20%, $20,000 above the asking price, or somebody putting 20 or 30% down, but they were at the offer price. So one was 10 or 20,000. I can't even remember what I said in my example here. More, if I called the lender and the guy with 10% down was well qualified, I would tell my client, hey, listen, you got an opportunity to make, 10,000, 20,000 more. You should, this looks to be a strong offer. So down payment matters. I don't want to say that it doesn't matter, because it absolutely matters, but there's a lot of things that play into it. It's typically not just one thing. So if I had two offers side by side, one was 10 they were both the same price. One was 10% down, one was 20 or 30% down. Typically, you go with the one that has the higher down payment in most cases, just because it looks to be a little bit stronger offer. But even then, as listing agents, we're making sure that these people are well qualified, that they're not, because just because you're putting 20 or 30% down doesn't mean your debt to income ratio isn't absolutely maxed out and you're barely getting that loan. So it requires some due diligence on behalf of the listing agent and the lender to have a conversation to make sure. So long way of getting to your answer there, but hopefully.
And here I'll give a little bit more color to that. So we talked about we had your client lose out on an offer last night, and Russ wrote an offer for a client, and it didn't come through. And actually heard from the agent, hey, well, what happened? Well, you guys are only 5% down, and the seller took an offer for 25% down because they've always put 20% down. They don't think it's right for someone to not have skin in the game. Said, okay, well, our offer was more, right? Your offer was more. And my borrower is gold plated, right? I mean, super high FICO score, plenty of money, low debt to income ratio. And at the end of the day, that the reason why that's infuriating as a seller, all you should care about is probability that it's going to close with low headaches and how much money am I going to net. So to sit here and worry about, hey, they should be putting more money down, it's kind of crazy. To each their own. The seller can decide whatever criteria they want to apply, but we always like to say it doesn't matter. A VA loan borrower doesn't have to put anything down, and that borrower can be spectacularly well qualified. Are you going to say, no, I'm not going to sell to someone and let them use their veterans benefit? It's just, again, everyone is always able to make their own decisions and choices on that. But from that end, we would like to at least tell them you're leaving money on the table.
No, absolutely. So I'm going to read Michael's question here. Josh, grab your link to Find My Way Home YouTube page and put it in the comments here. It'll actually probably come under me in the comments, but drop it in there if you would. So Michael's asking, is it better to buy new construction in this market or an existing home? Does new construction gain equity any faster than an existing home? So Michael, what I would say first off is go with the home that you can actually purchase. If you can find an existing home that meets what you're trying to accomplish, and or new construction, it really is a matter of preference, right? Some people don't want older homes. Some people want newer homes for whatever reason. I would say pick the one that best suits what your needs are, and what you want at the price that you want to be. So it's a hard question to answer directly on that, because it's all kind of a preferential thing. But typically speaking, new construction properties, you're not going to, if it's a builder and they're building multiple homes, in a lot of cases, you're not going to have the multiple offer situation that you might have on an existing home. So it might be easier to get into those properties. And a lot of times, if you're willing to pay their price, the property value, the price isn't going to get bid up in those cases, at least in my experience. Now, in the case that you're buying new construction, and it's a lottery and you have to wait and do all these other things, obviously that can play a part too. So there's a couple different factors that go into that. But to answer your question about does one appreciate faster than the other, in my experience, if you're able to get in the early phases of new construction when they're building out a development, those properties will appreciate quicker than some other properties, just because they're building more after it, and you're able to get kind of the early buzz, if you will, in buying as one of the first phases. But if you're buying towards the end of the phase or the end of the build out, I don't know that you're going to see that type of appreciation. What are your thoughts, Josh, on one appreciating faster than the other?
The biggest advantage that people see is, let's say a builder is opening, they're selling like gangbusters and they're opening phases further out. You can put it under contract at today's prices, and likely in 6-12 months, it's going to be worth more. You didn't have to do anything and you're going to walk into equity from day one. I think that's the biggest reason why new construction gets sort of a reputation of being able to build equity a little bit quicker. Builders are not dumb. So for the most part, they're going to price their homes accurately. They're going to know what they can appraise for. They're going to know what the market will bear. They do more market research than any seller or agent is going to do, and have a pretty good handle on it. It's just that you generally have that building lead time where it's going to be appreciating for you in the current market that will have you come out ahead. And like Jeb said, it can be a big temptation to just avoid the bidding wars and go in, if they have homes available, get something under contract. So it might be a way of not having to overbid nearly as much, and then have a lead time for the home values to increase while they're building it.
Awesome. So I'm going to post this up here and also ask a favor. So Jonathan's saying, you guys rock. Can you do these weekly? So we are doing them weekly, every Wednesday. They've started at 6 in the past. Now they're starting at 5, and we're going a little bit longer. So I think we're going to stick with this 5 o'clock time frame for the foreseeable future. It allows us to get to more questions. So we are here every Wednesday. Like to ask a favor though. If you're here right now, can you hit that like button, that thumbs up? Helps more people see the content, which obviously helps Josh and I accomplish our goal of trying to educate and help buyers and sellers in a crazy market. And if you aren't subscribed, do that as well. That greatly helps us out. So got a good question here from Moonlight Sunrise. Comments on a lot of my videos. So thank you for always commenting and the support. Another question. Well, I obviously missed a question, so let's just start with this one. I'm on an H-1B visa, expires in September of 2022. Will there be any problem for getting a loan? Working in the U.S. for the past 8 years, good income, good credit, 800 plus.
So for the most part, no, you're not going to have a problem. The history, so I'm assuming in 8 years here, you have a history of the renewals. They assume that you're going to be able to get renewed. You're eligible today to get the financing, and they're going to assume that there's a renewal based off of the history of renewals. So everything else there says you should be absolutely good. The good income, the 800 credit score, have a down payment, and have the history of renewals. The fact that it's expiring next year shouldn't be an issue for you.
All right, here's another one real quick. We'll throw this one up there. Same person, Moonlight Sunrise. Employers in Ohio planning to buy a house in South Carolina. They work remotely. Will this impact getting an approval? Any issues with underwriting?
This would come up once in a blue moon prior to COVID, and it's actually coming up pretty frequently now. The only thing that we have to do when we're validating or verifying your employment, your employer has to confirm on the verification of employment that you are able to work remotely, and that there will never be a condition of you being in the office. So as long as they do that, which everyone who's now been switched to remote and is doing their job well for the last 12 months from home, we haven't had a problem getting that from anyone's employer.
And I just want to read this person's name. So Honey Buns said, let's go, Josh.
It's not surprising that Honey Buns
these guys are competing.
Well,
look at this.
I'm not saying Moonlight Sunrise is a bad name, but I'd rather have Honey Buns on my team.
Well, hey, shows where your mind's at, man. So let's see here. So okay, so they answered the question here. LP Pap is asking, do you know much about the market in South Florida? Enough to have a conversation, but not enough to advise you on where things are going or what have you. I have a lot of friends in South Florida. I know a lot of real estate agents in South Florida. So, in fact, had a condo there for a number of years until the last housing crash took that from me. But anyway, that's a whole different conversation. So I know enough. But if you have a question, put it in there and we'll see if we can answer it for you. Let's see here. What else we got?
So just follow up a couple of these on the lock question. We went through the locks earlier. How much does it typically cost to lock a rate? There's not a cost to lock a rate. The rate lock itself is free. The rate lock you are getting will dictate the pricing. So let's say, because we said a 15-day lock is the cheapest. So if a 15-day lock, the 0 point rate, if you lock it for 30 days, maybe you're paying 0.125, an eighth of a point for that. And maybe for a 45-day lock, it goes up to 0.375. And maybe for a 60-day lock, it goes up to a 0.625. So you can either do that, you can take worse pricing on the same interest rate, or if you need to lock for a longer time, we can bump the interest rate and cover the cost of the lock. So there's not a cost that you're actually paying for the lock itself. The pricing for an interest rate varies based off of how long you lock the interest rate, the longer being more expensive.
Okay, so let's ask this question then, because I think this will be helpful. So I have a 30-day lock. I get to the end of the 30-day lock. for whatever reason, the loan's not done. And we need a week extension or a 2-week extension because something hairy in the file or what have you, and it got delayed. What happens with that additional time at that point? Is it something that I have to pay? Does the lender pay it? How does that work out?
It depends on whose fault it is. So if the delays are due to the transaction, that's not the lender's fault. It's not your fault, but it's also not the lender's fault. But let's say the lender drops the ball and they forget to order the appraisal. Appraisal's 2 weeks late coming in, and now we're delayed closing. The lender should be eating that cost for you, or reimbursing you for the cost. But it is, lock extensions are available. You can generally extend at least once, but most lenders will let you extend 2 to 3 times. After a certain point, they go, hey, we're not going to extend anymore. So it's important that we know how long we need. So let's just say there was construction going on in the house and it's not going to be done for another 2 weeks. So we would probably want like a 3-week extension to give us some wiggle room. For that, you're probably going to pay a 1/4 point to 3/8 of a point. So what I always get whenever I say that, it's funny, we've done this forever, and we know what a point is. A point is 1 percentage point of the loan. So that $300,000 hypothetical loan we're talking about, a point would be $3,000. So if we say it's a 1/4 point to extend that lock for 15 days, it's going to cost us $750. So that cost, if it's due to a lender error, it should come out of them. If we have, I mean, occasionally, it doesn't happen very often, but we'll get a buyer that's not responsive, and we're like, hey, I need an updated pay stub, or hey, I need you to document, like the previous gentleman asked, they're moving funds around. They don't move their funds in time. They don't get their money into escrow, and we have to get a 1 or a 2 or a 3-day extension. That's on you. So it really comes down to whose issue it is and how reputable the lender is that you're working with. We've never had an issue where we've asked a borrower to pay for an extension on something that was under our control. It also doesn't happen very often. I'm not going to say it never happens.
No, good. So I'm going to put this up there because we addressed a similar question earlier. Not a question. This is more of a comment. But we talked about dual agency earlier. Somebody asked the question, how often do you represent buyers and sellers in the same transaction? I said, not, you can go back and watch it, but basically it does happen. I do it, but I'm kind of against it. I mean, quite frankly, if they removed it, I would be completely okay where you're not able to do it. But this is an example, right? Selling his house or her house, not sure which in this case, and found out the listing agent only showed offers for their clients, did not present offers from other brokers in the MLS. So that's when dual agency can be a problem, when the listing agent or whoever it is that's representing that seller isn't ethical, not doing the things that they should be doing as a real estate agent, as a person, really. And in those cases, it's self-serving for those people, and and not representing their client in the best interest. So that's why I don't agree with it. So question here, how about Manhattan condo market? Should I buy now? So Josh and I are here in Southern California, not really that familiar, or personally not really familiar with the Manhattan condo market. But what I do know is that I know a lot of people fled the city during the pandemic, went to New Jersey, went to some other places. I do know that Manhattan real estate will come back. Maybe it's already started to come back. I don't know. But, the one thing I would say is that, if you look at where prices were a couple of years ago versus maybe now, if property value are down from where they were, you're probably going to be in a good position because people are going to go back to the city. I don't care what people say with migration patterns and what have you. People will always head back to these major cities for various reasons, whether it be work, entertainment, or what have you. So, outside of that, I don't really know the market well enough. Anything you want to add there, Josh?
No, it's all supply and demand, and there's not a lot of Manhattan real estate. So in general, in the long run, I would be confident that it's going to do just fine. In the short run, you get blips and weird stuff.
Right. Now, Adrian asked a question about 1031 tax exchange being removed by the current administration. So Adrian, we answered this earlier in the chat as well, or actually in the video as well. But, we didn't really go into what we thought. And I will say that I think it could happen. I think it could definitely be removed. Not to be political here with the comment, but the current administration is all about helping the greater good, if you will. And if there's a way to spread the wealth, if you will, with regards to tax, I'm going to quote unquote loopholes here, to spread that wealth and add taxes. I think there's a chance that it happens. So Josh, what are your feelings?
It's been around a long time, and there's a valid reason for it. You never know. In the current climate, anything's possible. Anything. So who does it benefit? It benefits people who own assets, and in the current political climate, people who have assets are easy victims, or easy to pick on, because they've done well. So anything's possible.
There you go. Michael asked another question. Is it harder to buy a condo versus a traditional home? No, not really. About the same process for the most part. I mean, the only difference in condos versus single family homes is sometimes you have, not being warrantable. I didn't even say that right. There are certain things that can pop up with condos that really aren't that typical here in Southern California. So in Southern California, buying a single family home, buying a condo is pretty much the same thing. There are some extra steps with HOA docs and some of those things that have to be done as part of the process. But outside of that, pretty normal. And then you have some markets like New York, as we were talking a minute ago, that have things like co-ops and some of those can be more difficult because there's just less lenders out there that actually finance those. So you can have less options with regards to, those versus traditional homes. Anything there, Josh?
No, really, just would say that the mechanics of it are a little different, but not really from your end as a buyer. We're going to get everything from the association management company. So mechanics are a little different, but nothing from your end. There's nothing that says, hey, guidelines are this on a house and this on a condo. So if that's the direction you want to go, you're absolutely fine.
There you go. Graciel has a question. Thanks for joining us, Graciel. How often does it happen when it goes to an underwriter that your PQ gets denied? If so, what would be another option or step when that occurs?
The answer for us in my office is never, and it's not because we're amazing. It's because we know the guidelines. My operations manager has been an underwriter for the last 20 years, so we know the guidelines better than the underwriters.
So explain PQ.
Just in pre-qualification. So you talk to a lender, they pre-qualified you, and then it goes to the underwriter, and the underwriter goes, no, this person's not qualified. So we probably should step back and go, if it's truly just a pre-qualification, there's a difference between a pre-qualification and a pre-approval. Pre-qualification, we talk on the phone, you tell me you make this much money, you owe this much debt, this is what you think your credit score is, and this is how much you have in the bank. That could easily get denied because that documentation may not come through. But generally, as soon as we have that conversation, I say, awesome, Graciel, let's go and do this. I'm going to send you a link to our online application, request for the supporting documentation, get that stuff uploaded, and we will have you fully pre-approved. Now from there, from a fully documented pre-approval to an underwriter declining our loan, it literally never happens. And I won't say that's because I or Lori know everything. What I will say is when we get to a point where something's dicey, it's going to go to an underwriter before we let that person go out and shop. I have someone from the YouTube channel here that we're working with right now, and they just have some issues in there where it's a little bit dicey. We are 92% confident that we will get the loan approved. I just want an underwriter to put their stamp on it before they go out and start looking at homes. And that will help us because there are some things that will show up on a pre-approval letter that are less desirable about this. We're going to actually put the full approval from the underwriter with the offer, not just a letter from us stating that they're fully approved. So the bigger question, Jeb, is how often does it happen out there in the market? It happens.
It happens all the time. Absolutely. Yeah. No, it definitely happens because people don't ask the right questions, don't follow up on the documentation. Hell, there's people out there that do loans that can't read tax returns and don't understand certain things. So yeah, I mean, it definitely happens. But that's why it's important to make sure you're working with a pro. Caleb has asked a couple times here on storage facilities. Any thoughts on investing in storage facilities? So I personally don't know a lot about storage facilities other than you can do very well owning storage facilities in areas where people need storage facilities. I guess it comes down to how much does it cost you to build them. It's no different than investing in a property, right? It's what's it going to cost you to buy it, to build it versus what's it going to bring in per month in income. People are always going to need to store things. land value is going to go up traditionally over time. These things make money. I mean, I know there's a lot of people that are very, very wealthy that own storage facilities. So I think they can be a good investment. Just depends on, how you're approaching it, and all the details of them. So
Everything I know, I learned on Storage Wars, so you don't want my input.
Too funny. Actually, one of those clowns is from here.
Yes, I see him at Almerson's all the time with his girlfriend. I think his girlfriend's a realtor.
How long does one wait to get a home if an individual started a new occupation? So I'll let you go with that, Josh.
The $1 million question is, how different is it from the previous occupation? Let's say if you used to paint houses and now you're a school teacher, so pretty different. We've got a big issue with that, and we need 6 to 12 months on the new job. A lot of it, if it's a new occupation, let's say that you were a school teacher, you get a W-2 and a paycheck from the school district, and now you just started a painting business that you go get your own jobs. You're going to be 2 years before you have that new self-employment. Now, going the other way, you were self-employed as a painter and now you got a job as a teacher. Once we have 6-12 months on that job, we're going to be fine. The biggest issue that a lender is looking for is just continuity of income. Is it likely to continue? And that's the reason why they don't want you to just start something up. Starting a new business, we have no idea and no track record of income. But starting working for someone else, like a school district who's been around forever and will have teachers and be employed, less time involved there. But definitely talk to a lender on that. There's not a set in stone answer, and some lenders will tell you it's got to be a year. Some will tell you it's got to be 2 years. Get someone that's aggressive, that knows the guidelines, that can document your file as well as possible and make that case with an underwriter.
All right. Honey Buns asked a question, and because, Honey Buns is rooting for you, I'm going to let you read it here, but Jennifer has the follow-up to it, so you don't even have to answer it. So,
just waiting list for a new construction home won't be available, and can I lease a new vehicle? The question is not can you? You absolutely can. Is it going to impact your ability to qualify? So if you're at the max of what you qualify for and you add a $1,200 Tesla lease on there, it can be a problem. It could impact your credit scores. Let's say you have a 620 credit score, you go out and lease the car, and now you have a 610 credit score, and it makes it impossible to qualify for the loan. So I don't ever say never do it. Say, let's think very seriously about it. If that client has an 800 credit score and they have a 10% debt to income ratio because they make $1 jillion a year, go lease whatever you want. It's not going to impact you. Most people are somewhere in between those two extremes, and they absolutely can go lease the car, but let's talk it through before you jump out and do that.
All right. The real question is, how many zeros does a jillion have?
A lot.
A lot of zeros. Victoria asked a question here. Josh, if I apply Candy.
Let me get it. I already read it. Hi, Josh. If I apply and my credit is 650 right now, and let me say by the time I get the house, my credit is in the 700s, are they going to use the credit now or the new one after closing or the new one for closing? We have this happen all of the time. We have clients that we need to improve their credit, and we can do a what if analysis and say, if we pay this off, if we remove this authorized user, if we delete this medical collection, it's going to get the score where we're at. We can always adjust it through the process. Now, coming back to tonight's theme of rate locks, if we want to lock the rate, you're going to see pricing for the 650 credit score. If and when we get the 700 and they attach that to your file, you'll see an update or a revision to your lock to the 700 credit score pricing, and you'll get it better. But yeah, we can absolutely do it. We can't do it at the 11th hour, like right before loan docs go out. But as long as we can get the rescore done, 5 to 7 days before closing, we can always substitute a better credit report.
There you go. That's great. Good stuff. Joe. So I'll go to this one real quick. So One Bright Light asked about old collections. So we actually addressed this a little bit earlier in the feed. If you want to go back and check that out. So did you want to say something, Josh?
Yeah, just the very brief answer to that. Conventional loan, it's determined by the automated underwriting system, and an old, smaller collection is highly unlikely. Unless it's very large, very unlikely to be required.
All right, there you go. If you're watching, hit that like button. Thank you. So would you recommend taking several opinions when it comes to the lender? I'm currently using Fairway Mortgage. Any thoughts on them? They're based in Arizona. So, here's my opinion as a real estate agent. So typically, I was a former mortgage broker myself, understand the business. It's good to talk to a couple of people, see who has the best rate, the best fees, see who you like working with, see who can answer your questions, gets back to you in a timely manner. People, you can communicate better with some people than you can others, and all that good stuff. So I would say it doesn't hurt to have a conversation with at least two people. I don't think you need to go 4, 5, 6, anything like that. I think that's way too much. But if you're going to do that, talk to maybe a couple of different types of lenders, maybe a mortgage broker, maybe a bank, maybe a credit union. Just kind of vary it up a little bit just to see what you're going to get. And then use that to make your analysis. But start with a referral. Start with somebody that had a good experience, that purchased a home, a friend, family member, somebody that that recently purchased, not your parents from 30 years ago, and find out who they used. Did they like them? What did they like about them? Find out. No different than buying a house or selling a house. Like, find out who did a good job, and then from there, let that person be your point of contact. And if you have a real estate agent, maybe your agent can refer you to someone who can help you. And you guys always hear me say this, but if you don't have someone, reach out to me. I'm happy to make that connection for you to somebody in the United States that, in whatever area you're in or state you're in, that can help guide you. Remember, lenders can do loans, depending on the state that they're in. They don't necessarily have to be in the same city as you. And we have a lot of great contacts. The same goes for real estate agents. So don't be afraid to reach out.
Jeb, the thing that I would add in there, there are a handful of companies. I don't want to comment on this specific lender, but there are a handful of companies that they have a higher cost structure. You get some things in return for that. Generally, they hire and employ good loan officers. So I'll have people ask me, well, I was talking to this guy, he's at this company. I say, well, how's your experience been? Well, it's been really good. Well, and how have you liked the process? Or, well, they do this and they do this and they do this. And I go, that's all cool. I go, the problem is that all comes at a cost. I said, talk to me. You're going to have a very similar experience. I'm not saying I'm any better because I think you're having a good experience with who you're with. Cost structure is going to be very different. So there are a handful of lenders that you may be talking to that they're doing a great job for you. And I feel bad when we take a client away from them. I feel bad from the sense that they're doing their job and they're doing a great job for you. They are just with a lender that has a high cost structure. Those are generally mortgage banks, or they happen to be people that run Super Bowl ads. Those are really expensive. So without naming any names, just know you're never getting a good deal from them.
Does it rhyme with pocket?
Yes, it happens too. So you're never getting a good deal from them. You're never getting an experienced loan officer with them. You're talking to a kid in the call center. You are getting the McDonald's of mortgages. But these companies are different. They actually hire really good loan officers, and you probably are having a good experience. But when you compare apples to apples, the last one I went through was a $5,000 difference. So do you like that person enough to pay them $5,000 more than someone who's also going to do an equally good job for you? Now, what I will always say, though, would you be better off with a kid in a call center that's going to save you $5,000, or someone at one of those higher price lenders that's really good at their job? No, you're always better off with the guy that's really good at his job, or girl. There's plenty of women in our industry that are awesome.
There you go. In fact, we refer a lot of them.
Yeah.
So Johnny's got a good question here. And this is more common these days than I think it's ever been, because people have a side hustle, if you will. So he's asking, if you have a regular job and a gig on the side, is there a minimum amount of time required for that gig job to be included as your total income? Josh.
So for the most part, gigs or jobs in the gig economy are 1099. You're an independent contractor, although the state of California has been trying to change that for a lot of them. If you are self-employed as an independent contractor, Most of the time, we're going to need a 2-year history. There are exceptions where we can get it done with 1 year on the tax return, but they're few and far between, and they would require a pretty strong and solid file. So I would count on a 2-year history of consistent income. If 1 year was high and the next one was really low, that can be problematic, because again, for most of these jobs, you're choosing how much to work. Maybe 1 year you needed a new car and you went nuts and made a bunch of money and bought the new car, and the next year you're like, I'm just getting some spending cash. It presents issues. It's definitely usable. It's no different than any other income, but we need to have it on the tax return. We need to have it documentable.
All right. Clip some easy. How often do home property taxes rise per year? Will the massive increase in homes causing a big increase in property taxes? So if you're fortunate enough to live in the great state of California,
It's the only tax you're not going to get hosed on.
Yeah, exactly. We have something that was implemented back in 1978, Prop 13, which limits the increase on property taxes no more than 2% per year, plus cost of inflation, or no more than 2% per year, right? But other states operate a little bit differently. So, I know that some states like Texas and some of these other states have 2-3% property taxes, and they can increase them based on, other homes selling in the area. I don't know it. I'm not well versed enough in other states to tell you how that operates, how often they adjust. Most have a time frame on how often they can adjust, and some don't have limits on how much they can increase. So I think it's going to come down to where you're located. Probably finding somebody that's local in your market to be able to answer that question for you, because quite frankly, I'm not sure. But if you're in the state of California, it's not going to affect, it's only going to affect you buying the property, because you're going to pay more property tax based off, the property being a higher sales price. Other than that, if you owned a property down the street and the new one came up and sold $1 million more than what you purchased yours for, it's not going to affect your value. So.
And that was the whole purpose of Prop 13 in California. We had people's grandparents who bought their home for $9,000, and now in the late 70s, homes were selling for $90,000, and they couldn't, even though their home was free and clear, they couldn't afford the taxes. So that can still happen in other states. Most of them assess on an annual basis. California reassesses on an annual basis. It's just the actual tax amount can only increase 2%. So for the most part, it is other states outside of California don't have the limits, and you're going to see big increases in property taxes.
All right. Charles is asking, how can I get a better interest rate with 25% down or 20% down? Now, I know last week you mentioned one that I think 15% down was kind of a anomaly, if you will. So I don't know if there's any other that you want to talk about here with these two.
25% will be marginally better on a single family residence. It'll be significantly better on a condo, because for whatever reason, in their infinite wisdom, both Fannie and Freddie have an additional loan level price adjustment for condos that doesn't go away until you put 25% down. So on condos, always advise, if you can do it, let's put the 25% down, because it'll get you better pricing. On a standard conventional loan, there's going to be a marginal benefit to being at 25 versus 20% down. Rates are still, even with the spike over the last 2 weeks, so good that I tell people generally not worth it. I'd rather have an extra 5%. Our hypothetical deal we've been talking about tonight, 300,000, it's 15 grand. I'd rather have 15 grand in the bank than save $20 a month on my payment. So another thing, you guys probably tired of hearing me say, numbers never lie. Put them side by side in a column next to each other and see what it is. And then you value yourself and say, how much is that additional 5%? How much is the difference in the monthly payment? What do I want more?
All right. So we're creeping on an hour 40 here. Maybe a couple more questions, Josh. So, here's one. Are there any cons when going with builder's lender versus a third party? So I'm assuming another lender. So builder's lender versus a bank or a broker or what have you.
Well, we have this happening right now, Jeb. It just happened this weekend. A listener here from YouTube contacted me. You guys went out, and the builder is always going to require you to cross qualify with their lender. They will not require you to get your loan from them, but they will always make you qualify. Again, because there are enough bad actors out in the mortgage business that either don't know what they're doing or don't speak truthfully. They want their lender to put eyes on the file and make sure that if the lender you want to use fails, they have a backup plan for you. Now, in general, I'm not saying that I've never seen a good deal from a builder's lender, but there's a fun little game that they all play. The lender doesn't have good terms, but to give leverage to make you use them or get you to use them, you get large incentives at the design center, or
Right.
sometimes just closing cost credits, but it's usually design center upgrades, things that the builder has already marked up. Well, then they mark them down to a reasonable rate if you'll use their lender. So again, numbers never lie. It's just a matter of penciling it out. 8, 9 times out of 10, we can still beat those numbers, even accounting for the incentives they give you. Sometimes we can't. So it's just a matter of penciling it out and showing it to you.
All right. Charles, thanks for the super sticker. Much appreciated. I saw one here that I wanted to address, and I cannot find it.
Let's throw a quick one in here. This one's easy.
Right.
Michael asks again, when my wife and I apply for a home loan, whose credit score do they use? I would assume they don't use both of our scores. Would a lender use the higher or lower? They don't use both because they just go to the lower. And so there's no credit. I literally have a situation right now. Husband, this is usually the opposite way. Husband has an 800 credit score. Wife has a 679 credit score. And we're having to operate off of her 679 credit score. We're working to get it higher so they can get better terms. But they're always, every borrower has 3 scores, 3 bureaus, 3 scores. You take the middle of those 3 scores and the lower of the 2. Or if we have 10 borrowers on a file, it would be the lowest of all of them, whoever's is worst.
All right. And you'll deuce? Is that right? You'll deuce? We'll deuce? Anyway, thank you. Thank you for the super chat. Awesome. You're great. I appreciate it. We appreciate it. We appreciate you being here. If you're here right now and you haven't already, hit that like button. Subscribe to stay up to date on everything real estate related. Do our best to answer all these questions. For those of you who have emailed me, you know that I do reply to emails. Not always instantaneous, but I do get back to you and try to answer your questions.
Step your game up, Jeb. When they email me, I get back to them immediately.
Yeah, well, you can have that. You can have that one. Oh man, my email's blowing up. With the forbearance property taxes not being paid, once it's over, will there be any tax liens? So, this is a good question, but one really hard to figure out what is actually going on. And the reason I say that is because I've been following this topic since March of last year. I do know that some lenders are paying escrows. They're paying the property taxes. So these property taxes are getting paid. If the homeowner is able to, when the forbearance ends, if they're able to get the deferment, those property taxes, along with their payments, are added to the back of their loan. They don't have to be paid now. If there's a repayment plan, they get, part of that repayment plan structure. I do know at the same time, there were lenders that weren't paying property taxes. So I'm not sure what is required at this point from servicers, from lenders, from the CARES Act, and what's not. So, there could be the case where these property taxes aren't being paid. But I would imagine that, if it was part of this forbearance agreement that was issued as part of the CARES Act, I would imagine they can't default or foreclose on you for not paying those. Maybe they can. Honestly, I have no idea. It's a tough question. Anything there, Josh, that you want to add to that, or anything
No, it's going to be an issue. The question is just how widespread. Like you said, some lenders are covering it. Some lenders are required to cover it with the impounds. So it's going to, when it comes back, that will have to be made up. It's easy for a lender to take the principal and interest and just tack it onto the back of the loan when they've paid out real funds to other people versus not collecting the money in. It kind of changes things. And then there are people that don't have impounds. There are people that own their homes free and clear, have been negatively impacted through the economy. So it's going going to be an issue. I think it's been overblown by some of the crazy people talking about the housing bubble that was going to be in 2020, that's now going to be in 2021, that their next videos will be that it's going to be in 2022. It's overblown, but it's definitely an issue. I don't think there's going to be no one impacted by it.
No, but also understand, I mean, I talked about this in a video I published today. There's a lot of equity in property, right? So, even if these people are behind on their property taxes and they're in a position where they have to sell their property to avoid foreclosure or what have you, maybe they're in a position where they can refinance, pull out some cash, pay that stuff off. I mean, just know that this isn't 2008 where people owe more than their home is worth. In some cases, yes, that is the case. That very well could happen. But in most markets, people right now owe less than the property's worth, with properties appreciating at the amounts that they're appreciating. And I mentioned this today in that video, is that properties are appreciating in most cases faster than whatever the payment that you're missing on that mortgage every month is being added to the back of that loan. So
yeah, but I was just playing the numbers through that in my head. Say you have a $500,000 house that you bought recently, it's going to be less than a $3,000 payment. So
I said 2,000 in my video today. So,
but you know what I'm saying? It's way less than 3. I know that. So call it 2,500. That's $30,000 over the course of the year. If that property increased 10%, like pretty much most states have, you have $50,000 of increased depreciation, $30,000 of deferred payments that need to be paid off. No one got in trouble last year not making their payments, and most people only had 7 or 8 months of deferment, if not less.
No, agreed. And I use different numbers today in my example, but the math still works out the same. I went conservative on the appreciation at 5% and said you had a $2,000 or so mortgage payment based on a $500,000 loan at a 2.75 rate or whatever I used, and you still made money last year, even if you deferred 12 full months of payments, which most people did not. So, Jose, thank you for the super sticker, and Adrian for becoming a member. Awesome. I appreciate both of you guys, and thanks for the support. Let's do one more here, Josh, and finalize it. And I want to say thank you to Jennifer for continuing to follow up and moderate the chat. Been awesome.
Throw Jose's last question up there.
Right.
I'll bump it real quick. We keep jumping on top of each other.
Yeah, there you go.
So, is it a good idea to go with a one-time closed USDA construction loan due to the lack of inventory for first-time buyers, or wait until the right house comes along? Here's the big question. This is coming from a guy that's flipped 40 houses, that's pretty familiar with construction, that's worked with a lot of contractors. If you do not own a home and you've never done any of that, it scares the shit out of me thinking that you're going to go run that gauntlet, including getting a loan, like everything. Like, I get it. It sounds awesome. Hey, I can get the house I want, pick my finishes, maybe control the costs. There's so many variables. You see, we just spent 2 hours answering a bunch of questions. First-time buyers have a million questions. I don't know that you're going to find a contractor that's great at answering all the contractor questions, that you're going to find a lender that really knows construction loans and going to answer all the construction loan questions, that you're going to find a realtor that helps you find a good piece of land and negotiate that. So I get this question a ton. The question I had this afternoon of another listener had reached out, VA one-time construction, one-time closed construction. And yeah, I get it. It's super attractive. It just scares me to death. So unless you maybe work in the construction industry, which I have a client right now that they're thinking of going with a construction loan, I'm like, okay, the dad's a foreman and the son that's going to do it works. Okay, I'm getting more comfortable with it, but just be careful.
No, there you go. So we'll end on that note. Back here next Wednesday at 5 p.m. Pacific Standard Time. Thank you guys for joining us. If you haven't done so already, hit the like button. You want to follow more content. If you want a topic covered that you don't see on my site, there chances are it's probably back there some way. But if you want something covered, up to date, leave that below. I'm happy to address those questions. There's contact information there for both Josh and I. Again, questions about finding a realtor, finding a broker, a mortgage broker. Somebody asked that question a moment ago too, and I'll answer that now. Joe, here we go. Joe, I just remembered you. What type of lenders did you say were best to go with? Obviously, I'm biased, but I say mortgage brokers. They have access to more programs, more options, typically a better fit. So mortgage broker. So if you need a mortgage broker or a realtor, reach out. Josh, any parting words?
No, I would say the same thing, but the caveat I always throw behind it, for 90% plus of borrowers, a broker is going to get you the best deal and have the best experience. But the most important thing is that you're dealing with an expert, and there are experts working for independent mortgage banks. There are a few and far between experts working for banks and credit unions. There are no experts working in call centers. So just using that as your waterfall for who you should be working with. I think a broker will take best care of most people, but if you come across someone that's awesome, like the guy in Arizona in Fairway, if you're happy with them and they're doing a good job and have high recommendations and good reviews, and you're having a good experience with them, I think above and beyond anything else, having an expert on your side that is there and also answers questions. I know people that are really good at this job and good at this business, and they're not good with people, so they don't walk you through it. They don't hold your hand through it. And a lot of times that's people that work with move-up buyers exclusively or jumbo buyers, which we have those, but 50% of our business is people that don't do this very often or have never done it before. So the big thing people always like to ask is, well, I know this is a dumb question, or you got to forgive me, I've never done this before. None of our clients have, and even the ones that have, they don't do it very often. So there's no dumb questions. Ask your questions, get answers. And if you're with someone that's not giving you those answers or acting and making you feel dumb, or that you're inconveniencing them, move on to someone else. There's plenty of us out there that are more than happy to walk you through it.
All right. That was a super long goodbye from Josh, but a great explanation. So we will see you guys next week. Have a good night. Bye-bye.